In September 2001, Compaq Computer Corporation was still the largest personal computer company on Earth by unit volume. Its Houston campus hummed with 18,000 employees. Its logo appeared on more desks, in more offices, more homes than any other name in the industry. 6 months later, the board voted to sell. The price was $25 billion, which sounded like a triumph until you realized the company had been worth nearly twice that just 3 years before. The name Compaq no longer exists, not as a company, not as a legal entity. A plaque somewhere in Houston might mark the spot. The rest is silence. To understand how that happened, you have to go back to a diner booth in Houston, Texas in 1981. Rod Canyon, Jim Harris, and Bill Murto were engineers at Texas Instruments, frustrated, underpaid, overlooking a pie they weren't eating. They sketched their idea on a placemat at the House of Pies on Kirby Drive. What they drew was a portable computer, IBM compatible, that could be carried like a suitcase. Unglamorous, heavy, exactly what the market needed. The IBM PC had just launched that summer, and it had a problem IBM hadn't fully anticipated. Its architecture was open. The operating system came from Microsoft, the chips from Intel, third parties IBM didn't control. Canyon and his partners understood something most of the industry had missed. If you could reverse engineer IBM's BIOS, the core firmware that told the hardware how to behave, without copying IBM's actual code, you could build a machine that ran all IBM's software legally. You could build a clone, and you could sell it for less. They did it cleanly, carefully, using a process called cleanroom engineering. One team documented exactly what the IBM BIOS did, its inputs and outputs. A second team, who had never seen IBM's code, wrote new code to match those specifications. IBM sued anyway. IBM lost. Compaq was legal, and it was off. The first Compaq portable shipped in 1982. It weighed 28 pounds. It looked like a small sewing machine case. It sold 53,000 units in its first year, a record for a first-year technology company at the time. By 1983, revenues hit $111 million. By 1984, $329 million. No technology company had ever grown that fast from zero. Wall Street called it the fastest company to reach Fortune 500 status in history. The culture that Rod Canyon built was methodical, Texan, and intensely collegial. Decisions were made by consensus around a whiteboard. No single executive dominated. The company prided itself on rigorous process, what insiders called the Compaq way. It was an engineering culture that believed deeply in doing things right, in building machines that customers could trust. And for most of the 1980s, that culture was vindicated by results. When IBM introduced its PS2 line in 1987 with a proprietary architecture designed specifically to lock out clone makers, Compaq organized a coalition of 9 other manufacturers, the Gang of 9, to develop an open alternative standard. They succeeded. IBM's attempt to recapture its monopoly collapsed. The clone makers won. Compaq, at the center of that victory, looked unstoppable. By 1994, Compaq had overtaken IBM in PC sales to become the single largest personal computer manufacturer on the planet. Its stock had made early investors wealthy beyond most projections. Its name meant reliability, scale, and corporate legitimacy in a way that its competitors envied. The question the company faced was not survival. It was ambition. Where do you go after you've beaten IBM? The answer they found would kill them. In 1997, Compaq's new CEO Eckhard Pfeiffer was looking for a way to move the company beyond the brutally competitive, margin-compressing PC business. Intel and Microsoft were extracting an ever larger share of the value in every machine sold. The hardware manufacturers, Compaq included, were being squeezed from both ends. Component costs on one side, price wars on the other. The entire PC industry was caught in what strategists call a commodity trap. Pfeiffer's solution was scale and services. Get big enough in enterprise computing, servers, storage, consulting, that you could compete with IBM and EDS on their own ground. The target was Digital Equipment Corporation, DEC as everyone called it. Founded by Ken Olsen in 1957, Digital had invented the minicomputer, had built the VAX line that ran the back offices of banks, universities, and governments across the world, and had, at its peak, been the second largest computer company on Earth. By the mid-1990s, it was struggling. The shift to networked PCs was eroding the market for standalone minicomputers. DEC had missed the PC wave badly. Famously, Ken Olsen had once said there was no reason anyone would want a computer in their home, and despite a late correction, the company never fully recovered its footing. By 1997, it was available. The price was $9.6 billion. The arguments inside Compaq for buying Digital were serious and not unreasonable. DEC brought the Alpha processor, considered technically superior to Intel's chips. It brought the Alta Vista search engine, then among the most trafficked destinations on the early internet. It brought thousands of enterprise sales relationships, the kind Compaq desperately needed to move beyond the retail shelf, and it brought size. Combined, the new Compaq would have annual revenues approaching $37 billion, making it competitive with IBM across every product category. The arguments against it were also serious, and they were made. Several Compaq board members and senior executives raised concerns about integration complexity. Digital had more than 50,000 employees. Its culture was East Coast, academic, engineering aristocratic, almost the inverse of Compaq's Texan pragmatism. Its systems were labyrinthine, its product portfolio overlapping and redundant. The people who flagged these concerns were told that the strategic logic was sound, that the integration would be managed carefully, that the prize was worth the price. The assumption buried in all of that optimism was that Compaq's management team, disciplined, process-driven, successful, could absorb a company nearly 3 times its size without losing the operational coherence that had made it great. That assumption was wrong. The merger closed in June 1998. Within months, the scale of the challenge became clear in ways the due diligence had not captured. Digital's sales force, accustomed to long enterprise sales cycles and high-touch relationships, did not mesh with Compaq's volume-driven retail model. The two companies had overlapping product lines that created internal competition, Compaq's Pro-Liant servers against Digital's Alpha server line, and resolving those conflicts meant picking winners and losers inside the combined organization, which generated resentment and departures precisely among the enterprise talent Compaq had bought DEC to acquire. Alta Vista, the search engine jewel that some inside Compaq had valued at billions in the dot-com heat, was mismanaged into irrelevance. The company launched it as an independent brand, then pulled back, then tried again, then watched Google arrive in 1998 and within 2 years render every other search engine an afterthought. The Alpha processor, for all its technical merit, was a dead end in a world standardizing on Intel's x86 architecture. Each of these losses, taken alone, might have been survivable. Together, they were not. The financial results turned visibly bad in 1999. Compaq reported a net loss of $2.7 billion for fiscal year 1998, its first annual loss as a public company. Revenue growth had stalled. The integration costs were running far above projections. And the broader PC market, rather than growing into the margin expansion FAFA had promised, was being further compressed by a competitor none of the 1997 acquisition models had adequately priced: Dell Computer. Dell's direct sales model, built to order machines shipped straight to customers, no retail markup, no inventory sitting in warehouses losing value, was devastating for any company built around channel distribution. Compaq's retail model required carrying inventory, paying distributors, and forecasting demand months in advance. Dell's required none of that. As PC prices fell through the late 1990s, Dell's structural advantage became compounding. Every price cut that hurt Compaq's margins hurt Dell less. Every quarter that passed, Dell closed the volume gap. In April 1999, Compaq's board removed Eckhard Pfeiffer. He had been one of the most celebrated technology CEOs of the 1990s, the man who had doubled revenues 4 times in a decade. He left without a public explanation, which in corporate language means the board had run out of patience and had nothing diplomatic left to say. His replacement, Michael Capellas, was given the task of fixing what the digital acquisition had broken. He cut costs, laid off thousands of employees, and attempted to restructure the product portfolio. Some of it worked, none of it worked fast enough. By 2001, Compaq's market capitalization had fallen from a peak of roughly $45 billion to somewhere below $20 billion. The stock that had made Houston millionaires was a fraction of its former value. The company was still large, still, technically, the biggest PC maker by units, but it was large in the way a great ship is large when it has already taken on water. The mass was there. The momentum was draining. In September 2001, Carly Fiorina, the CEO of Hewlett-Packard, called Michael Capellas. What followed was 5 months of the most contentious merger battle in Silicon Valley history. Hewlett-Packard's own board was divided. Two of HP's founding family members, Walter Hewlett and David Woodley Packard, campaigned publicly against the deal, arguing that HP would be buying Compaq's problems rather than solving its own. Institutional investors wavered. The shareholder vote in March 2002 passed by a margin of approximately 51 to 49%. Half of HP's own shareholders did not want Compaq. The deal closed on May 3, 2002. The combined entity kept the Hewlett-Packard name. Compaq became a sub-brand, then a brand applied to low-cost laptops sold through Walmart, then nothing. The last computer sold under the Compaq name, a budget laptop with no particular distinction, shipped sometime around 2013. Then HP discontinued it without ceremony. 18,000 Compaq employees lost their jobs in the merger's integration. The Houston campus was absorbed, restructured, diminished. The engineers who had reverse-engineered IBM's monopoly, who had organized an industry coalition to stop IBM's second attempt, who had grown from a placemat sketch to a Fortune 500 company in 2 years, most of them were gone. The lesson that Compaq's story teaches is not about innovation or disruption in the abstract. It is about a specific and underappreciated trap that successful companies fall into, the belief that the skills that built your success are the same skills required to multiply it. Compaq was an extraordinary executor. Its genius was operational, building reliable hardware at scale, managing channel relationships, competing on cost and consistency. That genius made it the world's largest PC company. When it tried to use the same organizational confidence to absorb digital equipment, it confused scale with capability. The ability to run a large PC operation did not translate into the ability to integrate a complex enterprise computing company with a different culture, different customers, and different competitive logic. Compaq didn't fail to innovate. It failed to understand the limits of its own competence at the precise moment it needed that understanding most. What makes this trap so dangerous is that it is invisible from the inside. The same discipline and confidence that built the company felt, to the people living it, like exactly the right tool for the job. The Compaq way had worked for 15 years. Why would it stop working now? The answer, because the problem had changed in ways the culture couldn't perceive, arrived too late to act on. That trap does not belong to 1998. It is alive in every organization that has been successful long enough to confuse its history with its destiny. The Compaq name is owned by HP Inc., which inherited it through layers of corporate restructuring. It sits in a trademark database. Occasionally, it appears on a budget device aimed at price-sensitive markets where brand recognition barely registers. Rod Canyon, the man who sketched the original idea on a placemat in Houston, watched all of it from a distance. He had been removed from Compaq himself back in 1991, ousted by the same board he'd assembled during an earlier crisis before the company's greatest years. He missed both the triumph and the collapse. There is something clarifying in that detail. The person who started it all wasn't there for the ending. What remained of his creation, the patents, the customer lists, the remaining brand equity, was folded into a company that itself later split in two. The placemat, if it still exists, is probably in a museum somewhere in Texas. $25 billion, the largest technology merger the world had seen. And in the end, what Compaq purchased with that money was not a future. It was an education in the cost of believing your own reputation.